All right. Today is Tuesday, May 11th. This is a recap for the stock market activities today. Folks, it's been a while since we talked last time. We have a lot of catching up to do. Let's start with the main theme last week. We had a clear inflationary theme of commodities, metals, financials, industrials, energy, and material names rallying higher. Meanwhile, we saw the Nasdaq, the mania names, the high multiple names getting crushed. However, the main mystery of last week was a confirmation of the inflationary theme from the bonds market. The confirmation was absent, meaning that yields were actually trending lower, not higher, even though we had a clear inflationary theme in the stock market. And we've been awaiting for that confirmation. Perhaps it would have come right after Friday's jobs report, which was disappointing, as you might be already aware of that, because the report shows that we have created only a little over 260,000 jobs in the month of April. However, here is the catch. This number was 100% cooked. It doesn't make sense at all. And it is a disgraceful attitude from the most corrupt government agency in the country, the Bureau of Labor Statistics. Mind you that the ADP jobs report, which only includes the private payroll, showed that we have created over 740,000 jobs in the private sector alone. Now keep in mind that the BLS, the Bureau of Labor Statistics jobs report, includes both the private and the public sector. So are you telling me that the private sector created over 700,000 jobs, but somehow the entire nation created only a little over 200,000 jobs? It doesn't make sense at all. The number was cooked, and they were cooking the number to manipulate the market, push the Nasdaq higher, and push yields lower to tamper inflation expectations. But in doing so, this cooking and manipulation managed to backfire on their stupid faces. Because suppose you take the jobs report at face value, that yes, matter of fact, we only created a little over 200,000 jobs. Okay, let's say that that is true. No questions at all. That only validates the theory that I've been touting in this channel for a long time, that the Federal Reserve's policies will lead us to the path of stagflation, meaning that the Federal Reserve's printing policy and flooding the market with a tsunami of liquidity, a needed tsunami of liquidity that magically happens to float all the way to the 1% in corporate America, leaving small businesses, the poor, and the middle class deprived of this liquidity. This policy will only be successful in creating inflation, but it will not necessarily mean recovering the employment picture. And if that is the case, we have plenty of jobs openings unfilled. Meanwhile, inflation continues to rise higher, then this is a recipe for stagflation and wage inflation. And right away I told you, the Nasdaq will reverse course and yields will start rallying higher. And that is exactly what happened. Yields recovered right on the same day, Friday, and the Nasdaq reversed and it continued to collapse into this week. Of course, the smarty pants in the news media started to catch up on that perhaps the algos are misreading the jobs report, because all of what we've learned from the jobs report is that wage inflation is real. And the propagandists in the Wall Street Journal and the likes, of course, threw cold water on that theory, saying that, oh, it's not about wage inflation or labor shortages, it's about a reassessment of the economy. Oh, really? And of course, the Biden administration seized on the weak, quote-unquote weak jobs report, saying that it means that the work is not done and we should do more spending and more printing and more programs, and all of that will lead to more and more inflation. The other main event that took place last week, or rather during the weekend, is the appearance of the con man of the century, the fraud father, Reverend Elon Musk, on Saturday Night Live. I told you ahead of time that after the appearance of the fraudster of the century on Saturday Night Live, Dogecoin will crash. And this is exactly what happened. Sell the news. And as expected, of course, he is humorless, no charisma at all, no presence at all. But in his defense, Saturday Night Live has not been funny for at least 15 years. And the other main important event that took place last week was the ransomware against the pipeline. And that is, of course, creating a shortage in gasoline, pushing gasoline futures significantly higher. There is panic buying going on, and the pictures that you see of people lining up in gas stations are reminiscent of the 1970s inflation. Now, we will talk about all of this and a lot more during the Headlines of the Day segment, which will be a separate video. We have a different format now, 2 videos, one covering the market's information, another commenting on the headlines of the day and all the important events taking place in the market. That video will come out later. But for now, let's start by covering the market's information and the market's performance today. And here we go. The Dow Industrial Average closing down in the red by 473.66 points, or a decline of 1.36%. The Nasdaq down by 12.43 points, or a decline of 0.9%. The Nasdaq was significantly down today in the morning, but managed to stage a recovery. Meanwhile, we saw the pain taking place in the Dow and the S&P 500, specifically in the so-called inflationary names. So what's going on here? Is the pain from the Nasdaq spilling over to the Dow and the S&P 500? Is the correction becoming contagious? That is the $1 million question. For now, all we know, we saw some short covering going on in the Nasdaq, in addition to some dip buying in the names that got whacked the most. Whether that is sustainable or not, that will depend on the CPI report tomorrow. So stick around for the conclusion of this video because we will discuss the CPI in details. But here it is, the S&P 500 also in the down by 36.33 points, or a decline of 0.87%. What about the sector's performances for the day? Leading the pack at number 1 and capturing the gold medal, materials, and for that matter, capturing the gold, silver, and bronze, because every other sector of the market closed decisively in the red, led by energy, industrials, and financials. So the action is a little peculiar today because you have the inflationary theme of energy, industrials, financials getting hammered today. Meanwhile, one sector of the inflationary trade, that is materials, managed to close in the green. And we're not seeing a lot of pain in commodities, by the way. The prices of iron skyrocketing, metals across the board, specifically copper, continues to go higher and higher. Matter of fact, copper is trading at all-time highs. So we're taking the action of today's activities with a grain of salt. We have to wait and see the market's reaction from the CPI report tomorrow. What about the advanced decline ratio for the New York Stock Exchange? 28% advancing versus 71% declining. A decisive day to the downside for the NYSE. What about the Nasdaq? Staging a very impressive recovery today. However, the decline to advance ratio, the market breadth, remains negative, with 42% advancing versus 54% declining. Moving on to futures, what's going on here? Futures holding steady. Some declines here and there, but from seeing the action in the stock market, when you see names that are proxy for lumber, for example, the likes of Home Depot, and home builders like Lennar down significantly today, you'd think that lumber futures crashed. That is not what happened today. Likewise, if you take a look at the energy sector, energy stocks or metals, they were down significantly today. At least for some names, you would think that crude oil and metals futures completely collapsed today. That is not the case because here it is. Crude oil, the WTI, closing in the green with a little over half a percentage point gains. What about softs? Massive gains for sugar, lumber, and coffee. Meanwhile, declines led by cocoa, cotton, and OJ futures. What about metals? Copper continues to climb higher and higher and higher. Copper is the most reliable indicator for inflation. We also saw gains for silver, meanwhile muted activities for gold. However, losses for platinum and palladium futures. What about meats? We have modest gains for live cattle futures, meanwhile declines for lean hogs and feeder cattle futures. And by the way, Tyson reported earnings this week, and they have indicated that inflation is rising higher, and they will indeed raise prices on customers. Inflation isn't easily controllable, as the Federal Reserve is trying to paint inflation to be. There is no magic wand to put the genie back in the box after it's already been out, because number one, the psychology has a massive role to play in inflation. If we all expect prices to go higher tomorrow, we will start buying now. That becomes a self-fulfilling prophecy. Likewise, companies are not going to wait for inflation to be quote-unquote transitory. It's already eating their margins, so they will start raising prices now and passing that extra input cost to the end customer. Therefore, once again, inflation becomes a self-fulfilling prophecy, out of control of the hands of the Federal Reserve, regardless of what these propagandists continue to say. What about grains futures? Gains led by soybean, wheat, soybean oil, corn, and soybean meal futures. Meanwhile, declines, big ones, led by canola, rough rice, and then modest declines for oats futures. Moving on to the big casino, the options market. Let's see what's going on here. Surprise, surprise. Number one, ExxonMobil. With a little over 1.5 million contracts, check this number out, 97% of those were calls. Now, if you've been a follower of this channel for a while, you know that when we see elevated call options buying for blue chips, and we saw that before with AT&T and last week with Pfizer, that is usually an indicator that the stock will actually decline, not rise. And that indeed could be the case with ExxonMobil. However, with the gasoline shortage and the upcoming CPI report, the trajectory for oil prices are higher, so perhaps we're seeing lots of dip buying via call options in the name today, and we will see ExxonMobil popping higher again very soon, perhaps as soon as this week. At number two, we have Apple, and the volume is starting to recover with a little over 1.1 million contracts traded today for Apple. About 63% of those were calls. And at number three, Palantir, PLTR. The name reported earnings today. It was down significantly in the pre-market, and remember, the name is down 60% or so from the highs. Meanwhile, the geniuses over at YouTube, you know, the bros, the financial experts, been pumping the stock over and over and over again. And at some point, you have to ask yourself a question. If some zip on YouTube saying, buy these 3 stocks now, and one of them is Palantir, to the moon, it's gonna double. Meanwhile, the stock goes down 60% since the call. Does this person have any credibility left at all? Furthermore, heed this warning when it comes to Palantir stock. Yes, it is a promising company. I have no doubt in my mind that Palantir will be a $20-30 billion company in the future. However, it is not a 30, 40, or even $80 billion like it was before right now. In addition, I made a video with the latest insider trades. In that video, I showed you that the CEO Alex Karp will continue to dump stocks because he has to, all the way till the end of the year. Meaning that if you are buying this stock, the CEO is betting against you. He will continue to dump all the way till December of this year. Every share you buy, Alex Karp will dump 1,000, meaning that you are standing in front of a massive giant train. What about the unusual trades taking place in the options market today? Let's start by the ticker EWZ for the Brazilian ETF. They're making a bullish bet here by buying the 41 calls, expiration date July 16th. With expectations that the name will rise over 7% by then, they paid about 82 cents a piece to enter this trade. All in all, bringing the total to about $1.6 million. What about the trade for the ticker DKNG, DraftKings? The name got hammered significantly after earnings. It's been getting hammered way before earnings, but the hammering intensified after earnings. And I had a bullish trade on this one playing earnings, and that was a bad trade because the name went down after earnings, 6% or so, and an additional 6% or so starting this week. Massive declines, and at some point, the name has to bounce. So perhaps my trade was a little early, and if you are betting on a rebound for DraftKings, perhaps you should follow this one instead, because the trader is buying the 48 calls, expiration date May 21st, with expectations that the name will rise over 9% by then. They paid about 70 cents a piece to enter this trade, all in all, bringing the total to about $700,000. What about the trade for the ticker BBY for Bed Bath & Beyond? They're making a bullish bet here by buying the 27 calls, expiration date July 16th, with expectations that the name will rise over 8% by then. They paid about $2.20 a piece to enter this trade. All in all, bringing the total to about $1.7 million. What about the trade for the ticker XLK for the technology ETF? They're making a bearish bet here for more pain to come for the tech sector by buying the 122 puts expiration date June 18th, with expectations that the XLK will collapse over 10% by then. They were willing to pay about $1 a piece to enter this trade, all in all bringing the total to about $700,000. What about the trade for the SPY, the S&P 500? Usually I do not pay attention to trades that cost 1 cent a piece, but there is a point to illustrate here because they're making a bearish bet for tomorrow. The expiration date for this trade is tomorrow, May 12th. They're buying the 365 puts expiration date, like I said, tomorrow, and they are expecting the SPY to drop over 11% by then. They paid 1 cent a piece to enter this trade, all in all bringing the total to about $5,500. Now, why is this trade important? Because we have the CPI report tomorrow, and the expectations are that if the CPI report comes out hot, you will see the Nasdaq suffer again, yields climbing higher, and perhaps names like financials and the inflationary trade rising significantly higher, meaning that the SPY will actually go higher. However, if the number is cooked, and it will be cooked 1,000,000% for sure, this is the most corrupt government agency ever, the Bureau of Labor Statistics. They're not going to hide all the truth, but all they have to do is cook the number good enough to show some inflation, but not as high as the expectations are. What will happen is the Nasdaq will blast higher and the SPY will trend lower, along with the Dow Jones perhaps. Why is that? Because the inflationary trade will start to sell off, and market participants will buy the dip in the Nasdaq and the beaten down high multiple names. So this is an interesting trade. I don't know what the algos are going to do tomorrow, but one thing I know for sure, the number will be cooked. Lastly, what about the trade for the RKK, for ARK Invest Cathie Wood ETF? We have 2 trades here, so pay attention. It's a bullish bet, a call spread by buying the 116 calls and selling the 117 calls. The expiration date is May 28th. They're expecting the RKK to continue to rebound all the way to 12%, but not more than 12%. They paid about $1.25 a piece for the 116 calls, and they received $1 by selling the 117 calls. All in all, the entry cost for this trade is 25 cents a piece. That brings the total to about $130,000. The RKK was oversold and it was due for a bounce, and you saw a massive bounce in this name today. From the lows of the day to the highs of the day, the rebound was about 6%. So a massive rebound with high volume, lots of short covering, lots of dip buying. So we will see if the RKK will continue to bounce higher, or will it reverse after the CPI report? Remember, the RKK is becoming the main target for bears and shorts against this bubble. It is becoming a representation of how bad it will get in the stock market if yields continue to rise higher. The assumption is that yields, in terms of the medium-term trajectory, is higher, meaning that the RKK will also reverse and start trading lower. The question is, how high will the bounce get us? This trader is thinking all the way to $117. Moving on to the heat map analysis, and this is very important because the inflationary trade of financials is underperforming. Industrials, energy, defensives, similar story. The exception is materials. Freeport-McMoRan closing the day with gains almost 5%. Steel names outperforming significantly. You have another name for metals, Vale, also closing with gains of about 3% or so. Meanwhile, the disinflationary trade of high multiple names, the likes of the software sector of the market, the stay-at-home names, the likes of Zoom, Peloton, managed to outperform today. And my theory is we're seeing lots of short covering prior to the CPI report. And perhaps some dip buying because some of these names got whacked severely and reached very extended oversold conditions. But we don't have a confirmation for this action because if you are betting that this is a reversal of the theme from last week, meaning the disinflationary trade will start to outperform the inflationary trade, watch out because you don't have a confirmation for the downside in the inflationary trade because materials are up big today. Likewise, you don't have a confirmation of the outperformance for the disinflationary trade because the big cap cap technology names are actually underperforming today, with the exception of Amazon. So once again, taking the action from today with a grain of salt, we have to see how the market will react to the CPI report tomorrow. Moving on to the charts analysis, starting with the Nasdaq 30 minutes chart, because all of the action took place in the Nasdaq last week, and it seems like the Nasdaq is a leading indicator for the rest of the market. So let's see what's going on here, step by step. And I guided you through the chart of the Nasdaq step by step like a baby. On April 8th, I explained to you that the market reversal would happen in a gap and crap scenario. This is exactly what happened later in the month. You see the gap and crap candle. And when that happened, I gave you the confirmation on Twitter saying that this is the gap and crap reversal we've been waiting for, April 29th. And then I made a video. If the gap and crap was not convincing enough to you, the Nasdaq got rejected twice from the level of 340, and I made a video about that. When you have a double rejection succeeding a gap and crap, what more do you need to confirm that the Nasdaq will turn lower? This is exactly what happened. You saw the breakdown. The Nasdaq tried to recover only to be faced with another gap and crap and a rejection, and it went down. And then it started to form a bottoming formation. First, we saw the double bottom formation, followed by a higher high. And that was Thursday of last week. And I issued this tweet saying the triple Qs is attempting to form a short-term bottom. If the chart appears to be closing above 330.5, I will be closing my SQQQ calls, and I will use a tiny bit of the proceeds to buy SQQQ's puts expiring tomorrow, meaning the jobs report Friday. This is exactly what happened, by the way, because the Qs managed to close above 330.5 on Thursday and right away gapping higher after the Fugazi jobs report. But here is what I said on Friday. Remember, I said the Qs will reverse down and yields will reverse higher again, because all of what we've learned from the phony jobs report is the wage inflation is real. And here is what I said. I closed my SQQQ calls yesterday and bought puts expiring today. If yields recover, the pop in the Nasdaq will fade and I will buy SQQQ calls again. Now the SQQQ's puts expiring last Friday, I bought them for 1 day. Right after the pop in the morning, these were up 500%. So that was a quick flip right there, and I started buying SQQQ calls once again. And here is what happened next. As we started trading this week, we saw a gap and crap. That was Friday's activities. And then we saw a bear flag formation on Monday, and that led us all the way to the breakdown, the floodgates, as I told you, that we saw in the morning today. However, after a period of severe declines in any chart, not just the Nasdaq, by the way, when you see a gap down, a significant gap down, and then you see a recovery right after, and the market closed at the highs of the day, you could call this a bear market rebound. You can call it whatever you want, a dead cat rebound. It doesn't matter to me, the terminology. What matters is that these types of rebounds usually last for more than a day, and they are extremely powerful. And therefore, I closed my SQQQ calls today. Now, here is the catch. Yes, the rebound, the assumption is that the rebound will continue in the Nasdaq tomorrow. The problem is that yes, the Qs managed to recapture the level of 323, but it is struggling to recover 326. That could happen tomorrow, but what do we have on the calendar tomorrow? We have the CPI report. And here you have the conflict between technicals and the fundamentals. I know a lot of you are just interested in charts analysis. You want to see a bunch of charts, a bunch of lines, a bunch of tickers, and that's it. Good luck to you. But you're not going to last in this game for too long. You got to combine the technicals, the fundamentals, the news, the psychology, and everything else. And while the technicals are suggesting that the Qs could continue to bounce higher tomorrow, if the CPI comes out hotter than expected, triggering a rally in yields, you will see the Nasdaq resuming the roll down on the stairway to hell. What about the daily chart for the continuous contract futures for the Nasdaq? We had the double top formation. We had the support of 13,599. That was broken. And then we had 13,300. And I told you that this level should hold at least intraday. This is exactly what happened today. Because after this level, we have some soft supports, but there is a massive gap all the way to the next support of 12,766. Meaning that if the Qs fail to hold on to the support of 13,300, we will fall down, another flush down all the way to 12,766 2026 at least. We still have a negative divergence on the RSI and a negative crossing in the MACD indicators. And by the way, a few days ago they had this study that the RSI and the MACD indicators in specific, but technical analysis in general, did not do good in 2020 and 2021, meaning that technical analysis lost its allure. Perhaps you're following some technical analysts over YouTube and they're getting it wrong and wrong and wrong day after day. Don't blame them, because according to this study, technical analysis in general has been underperforming, and therefore this channel has a comprehensive coverage of the stock market, not just technicals, but fundamentals, macro, psychology, sentiment, and everything between. However, I beg to differ with this study that the RSI and the MACD indicators are the least technically reliable indicators. Because ask yourself a question: how did this channel predict the reversal in the Nasdaq ahead of time? By using the RSI and the MACD indicators. I believe that the problem is most technical analysts don't know how to use the RSI and the MACD indicators properly. I've been using these two since I was a toddler, and they have been extremely reliable for me. Moving on, SPY 30 minutes chart. What's going on here? We talked about the SPY, and we had a question from a viewer saying, why is it that the SPY continues to outperform, meanwhile the Nasdaq continues to get whacked? I explained back then that the technology block has a sizable weight in the SPY. However, there are other sectors of the market in the SPY, the likes of financials, industrials, metals, defensives, energy, the inflationary sectors of the market. If these continue to outperform, the SPY will continue to outperform as well. Once these start to get shot, then the SPY will start to get hammered too. This is exactly what we started to see today, the contagion effect. Is it sustainable? Is it not sustainable? That remains to be seen. But for now, once again, we had the gap and crap. That was a reversal signal right there, even though we saw an intraday recovery, a V-shaped recovery. And the SPY caught support from the 417.30 level, going all the way to 420 before reversing lower and bouncing higher from the support of 412, only to be faced with the rejection from the former support, now resistance of 417.30. And the SPY started to trend lower. However, we started to see the higher highs. These are once again signs for bottoming and a reversal of a trend. In this case, the bearish trend. And right away, you saw the SPY blasting higher, all the way surpassing the 420 resistance level. It was forming a bull flag formation. That consolidation of the bull flag formation should have played to the upside. Once you see a failure to break out, that is an extremely bearish signal. And right away, breaking not the support of 420 now, but the 417.30, and all the way today, breaking the support of 412, even though managing to close above that level by the end of the day. And notice the reactions from this level, the zone of 412. The SPY managed to bounce not once, not twice, not third or fourth, but for the fifth time, the SPY catches support from this level, meaning that 412 is an extremely reliable support level. What does that mean? It means that the SPY should be able to rally all the way to 417.30 at least. But it also means, on the flip side of the coin, that breaking the support of 412 and closing the day below 412 will mean that the floodgates will open for the SPY. What about the daily picture for the SPY futures? What's going on here? The trend remains higher, but I've been giving this a thumbs down, and I wasn't buying this extended move higher. And you are starting to see that this very extended trend is starting to reverse. And once again, that was confirmed by what? The RSI and the MACD indicators. And now you're seeing the volume spiking higher on the downside. That is yet another confirmation that we are seeing weakness in the SPY. So I don't know what these people are saying about the RSI and the MACD being unreliable. Perhaps they don't know how to use them properly. And the support remains if we see a flush down all the way to 3,960. What about the IWM? Likewise, the gap and crap followed by a series of bear flags, leading us all the way down to the support of 218, very close, and we saw the double bottom formation. That led us higher all the way closer to the gap. But the IWM managed to reverse before closing the gap. And this is yet another bearish technical signal that I teach when doing these chart analysis. When you reach a gap and you reverse before closing the gap, that is usually an ominous signal. And that led us down all the way, piercing the 218 support, and now we have somewhat of a bear flag formation that should result in breaking the 218 support level. However, Today we saw the meme names, the high valuation names popping higher. If this action is sustainable for a few more days, then the next destination will be breaking above the resistance level of 223. Why do we have this conflict in the Russell 2000, by the way? To illustrate that for you, let's zoom out to the daily chart of the RUT, the Russell 2000, the big sibling of the IWM. We've been in this conflict, in this consolidation around the level of 2,264, going back and forth for months now with no definitive conclusion. The bulls have the advantage for a while. Now the bears have the advantage, but it is a small, slight advantage. We're going to have a breakout one way or the other, up or down, and it will be a violent breakout out of this consolidation. And you have to ask yourself a question. What will be the catalyst for a breakout to the upside in the IWM? We already have pretty much every positive catalyst we went through. The only available catalysts are to the downside. What about the dollar index? What's going on here? I was anticipating a breakout higher in the dollar index all the way to 92. But what happened is a break to the downside all the way to 90. And here it is again, the importance of the MACD indicator, which they continue to say it's not relevant, it's not important, it has been the least accurate indicator. Bullshit, because here it is, another thing that I teach in this channel. When you're about to cross in the MACD indicator, up or down, and then you see a reversal of that course to the opposite direction, that is usually a very ominous signal. For example, in this case, the dollar index was destined in the MACD indicator to make a positive crossing to the upside, creating green impressions in the histogram. And then it decides to reverse course, and the momentum starts to slow down. Right away, that is an ominous signal, and vice versa. If a chart is about to cross to the downside in the MACD indicator, then reverses course and trends higher again, that means that the move to the upside is not through yet, because the momentum is still here and it is building higher. The dollar index has excellent support at 90 at this time, but you might have heard the interview with Drunken Miller and many Fed critics who are pointing out that the current policy, the monetary policy that is, will indeed result in the destruction of the reserve status of the US dollar. So once again, I've been a bear on the US dollar since last year, and that was the main thesis for me to be bullish on copper starting last year before everybody started talking about it. Now all you hear is buy Freeport McMoran, etc., etc. I've been saying this since last year. What they're doing is destroying the US dollar. They say don't fight the Fed. Okay, you don't want to fight the Fed, then bet against the US dollar, because they're in essence destroying the reserve currency of the world. And by the way, here is something else you're not going to see in any other channel. The correlation between the 10-year Treasury yield and the dollar index. DXY in blue, the 10-year yield in yellow. Notice that yields are a leading indicator to the movement in the US dollar. You see the correlation, the box in yellow. Yields pop higher, then years later, the dollar index pops higher. You see it again in the box in red, and the turn down in the box in green. However, you see these two circles in yellow, 2009, 2010, where we saw inverse relationship between the US dollar and the 10-year Treasury yield. Why does this phenomena happen when usually the 10-year Treasury yield is a leading indicator to the movement in the DXY? It happens when the Fed puts their thumb on the scale. And back then it was the quantitative easing in the aftermath of the financial crisis. So every time the Federal Reserve intervenes, the correlation changes and it becomes inverse correlation. Once again, you see the box in purple, yields popping higher, and then month later, the dollar index has that massive pop in 2014. And you see that again in the box in white, yields pop higher, then a few months later, we see the US dollar also popping higher. The correlation is very strong between the US dollar and the 10-year Treasury yield. However, when the Fed intervenes, unleashing the tsunami of liquidity, the relationship becomes inverse. Meaning, now that we have seen the 10-year Treasury yield popping higher, the lagging effect will catch up with the dollar index, and you will see the dollar flushing down. That is at least my analysis and my interpretation. And you're not going to hear this outlook and this analysis anywhere else. What about gold? What's going on here? We talked about gold, the bull flag formation, consolidating. You have the dollar down and you have yields being muted. Both of these conditions are positive for gold, and gold is now battling the Fibonacci retracement level at around 1,850. The assumption is if yields pop higher again in the aftermath of the CPI report, then gold will trend lower, and vice versa. What about BTC, Bitcoin? What's going on here? You know, the smile has been wiped off the faces of the Doge maniacs and the cum rocketers and the likes, the mania names in the stock market, the Plug Power, the Neo, Palantir, etc. But one smile that hasn't been wiped off, the faces of the Bitcoiners, the cryptomaniacs, specifically the tulip chasers in Bitcoin. They continue to be arrogant and highly confident, even though the risks are piling up against Bitcoin. And here we have a giant bear flag formation that is supposed to play to the downside, leading Bitcoin all the way down to 42,000. The problem with Bitcoin, of course, is the risk of regulations, whether it is from the SEC, of the Treasury, the Justice Department. Now we have the ransomware against the pipeline. And of course, the criminals are asking to be paid in cryptos. Don't say that the warning signs were not there. This tulip mania will come to a crashing end, and it will be the most violent crash that you have ever seen, in stocks or otherwise. Bitcoin will be the one thing that we're going to remember from the popping of this bubble. What about Doge? What's going on here with the Elon Musk culties? They placed their hopes and dreams just like they did with Battery Day, and that comes out as an overhyped event, and Tesla stock actually reversed in the aftermath of Battery Day. Sell the news. Here we have another sell the news phenomena with Dogecoin. The fraudster of the century, the con man of the century, Reverend Elon Musk, comes out on Saturday Night Live with his dull appearance and lack of humor. But who cares, because Saturday Night Live hasn't been funny for a while. They do all that woke stuff, and comedy in general is dead in the woke era. But here it is, a reversal for Doge, and now we have an important line at the 45-cent level. We have a double bottom formation. That is the bullish outlook for the chart. Is there a bearish outlook for the chart? Yes, it is. This whole consolidation is a bear flag formation that is supposed to play to the downside. What do you do with this information? You have a bullish outlook of the double bottom, and you have a bearish outlook of the giant bear formation. Bear flag, that is. You're not going to know how the chart will behave one way or the other. But if the bullish outlook is playing out, Doge will confirm that by reaching and closing above the level of 60 cents once again. How do we know that the bearish outlook is in play? If we close below 45 cents for the week. And I know that this is continuous trading, pretty much 24 hours. But the weekly closing on Friday is critically important. Closing below 45 cents decisively, that means, boy, there's a lot more pain to come here as the outcome of the giant bear flag consolidation plays out. But here is the most important chart to watch, at least for tomorrow, the 10-year Treasury yield. We had the head and shoulder formation, followed by bear flags that led us all the way to the downside, reaching 1.5%. And I told you, if yields go down to 1.5%, I will be buying with both hands. Buying what? Because you can't buy yields, but you can't play the rise in yields by shorting the TLT or buying the TBT, which in essence shorts the TLT. You can also double down by buying financials, the KRE, etc. There are so many ways to play the rise in yields. The point to illustrate is we have this descending line, and finally the chart managed to break above the consolidation descending line, but it is just a matter of time before yields break all the way above the highs of the year, reaching the 2% level. The Federal Reserve unleashed inflation. I don't know why they want inflation, and why do they think that inflation is a good idea in recovering the economy? How does inflation and increasing prices higher help the poor and the middle class, who are just coming out of a pandemic? And if the jobs report on Friday was accurate and the country only created 266,000 jobs, then it is yet another proof that the current policy of the Federal Reserve is misguided at best, creating inflation and not recovering jobs. Once again, they're mad scientists playing with fire, playing with the financial future of this country. They're unelected fools. What about the TLT bond prices? Well, if we think that yields are rising higher, then the TLT is going to go down. And you see the crossing in the MACD indicator signaling weakness in the momentum. What about the VIX? I've been saying that the VIX will break above 20 once and for all. I gave it the bull flag formation. It went up, it went down, it didn't matter. The trajectory was higher, once again, because the RSI and the MACD indicators showing an increase in momentum. So tell me again that the RSI and the MACD are bullshit indicators. Perhaps you don't know how to use them. That's a different story. And what about the most important stock in the market right now, Apple? As Apple goes, so will the Nasdaq. Gap and crap, followed by bear flag formations, and you saw the flush down right after breaking the very critical support of 131, which happened to be the center of gravity. That was a nasty pullback. We saw a gap and crap once again, but the chart started to form higher highs, which is a bottoming formation. And then came the rejection once again from 131. That was a confirmation to turn back to the bearish side. So what do we see now from the action today? Big down day, gap lower, breaking the support of 125, but bouncing higher. There is a gap and crap, but there is the inverse of gap and crap. Gap and rise. Gap and rise is usually a bullish formation, signaling a short-term bottom. But remember, we have a gap and Apple did not close this gap. Reversing before closing this gap and breaking the support of 125 will be an ominous signal to double down on your Apple shorts if you have some. Once again, the CPI report and the reaction of yields will determine the next move for the Nasdaq and for Apple for this matter. What about Tesla, the souffle? What's going on here? Lots of troubles for the souffle. I think this magic that Elon Musk had for a while of pumping the market higher via tweets, that is starting to fade away as people wake up to his scams and realize that this guy is a con artist, pumping Doge, pumping Bitcoin, pumping empty crap with no value at all, trapping amateur investors who believe in this guy and respect this guy. And once they start to lose their money, not once, but twice, not just in Doge, but in Bitcoin and in Tesla and every other endeavor that he tries to pump, he will start to lose his magic and his reputation. The man is absolutely stupid for a smart guy. Anyhow, I gave you the line in the sand, and the line in the sand was 679. Breaking below that level will open the floodgates of pain for Tesla. And once again, you can talk smack about the RSI and the MACD, but they have predicted all of that ahead of time. The negative divergence in the RSI, the negative crossing in the MACD indicator, all of that told us ahead of time that there is more pain for Tesla. The biggest risk for the souffle. Number one, the risk of a tsunami of margin calls, because the retail traders who pumped Tesla higher continue to hold. But if they start to get margin calls, their positions in Tesla will start to be liquidated. In addition, Tesla now has a direct correlation with Bitcoin and Dogecoin. Thank you to Reverend Elon Musk for playing with this company, meaning that if BTC or Doge crash, Tesla will feel a lot of pain. And now he's playing with SpaceX, by the way. I mean, the man is out of control. Doge will crash one way or the other. It's a tulip and it will take down Tesla stock with it. Moving on to the conclusion of this video, we have the most important number to watch tomorrow, the CPI report, aka the CPI. This time around, the cooks are going to be busy in the morning, trying to cook a number showing some inflation, but not as high as the market is expecting. And that will allow the market to recover, at least for the Nasdaq, crushing yields lower. But the cooking will be extremely difficult. Here is why. We have all the evidence suggesting that the CPI should read at least 3% increase year over year. That's a minimum. Number one, the correlation between the CPI and the ISM manufacturing composite. It has been an extremely accurate correlation throughout the years. So why would it stop right now? If the manufacturing composite reached all-time highs, or the highest reading in decades at least, then the CPI should at least reach 3%. Evidence number two, the correlation between M2 money supply and inflation. When the money supply rises higher, inflation follows through. This has been an extremely accurate correlation going back all the way to the 1800s. So you're not going to be able to cook your way out of this one. Evidence number three, the US cyclical defense ratio year over year versus the CPI year over year. Once again, we have a high degree of accurate correlation going back at least for 2 decades. The US cyclical to defense ratio rising higher, signaling that the CPI should read at least 4% increase year over year. Evidence number four, the Empire State Index prices paid versus the CPI. Another high degree of correlation throughout the years, going back at least a decade and a half. The Empire State Prices Paid Index is indicating that the CPI growth year over year should be at least 5%. Evidence number five, the non-farm unit labor cost versus the core CPI. Again, a high degree of accurate correlation going all the way back for at least 2 decades. And if this correlation holds, then the CPI should read at least 3% increase year over year. Evidence number six, and I am starting to lose count, by the way, the mention of inflation in corporate earnings versus the core CPI year over year. Once again, a high degree of correlation, Not as accurate as, say, the Empire State Index prices paid, but there is a high degree of correlation. And if this holds, the CPI should read at least 12% increase year over year. You think the cooks will allow that to come out? Of course not. Evidence number 7, and this is of extreme correlation with high accuracy. You have the CPI year over year and the trend model year over year. And if this holds, tomorrow's report should show the CPI rising 7% year over year. Evidence number 8, core CPI versus the NFIB actual price changes. And if this correlation holds, tomorrow's CPI report should at least show an increase of 3% year over year. Lastly, the copper to gold ratio, which has an impressive correlation with the 10-year treasury yield. And if this relationship holds, then why shouldn't it? Absent of the manipulation, yields should shoot up all the way to surpass 2.5%. So in conclusion, we should get a minimum of a 3% increase year over year in the CPI. And if it is just 3%, the market will celebrate that. And that would be a cooked number, by the way. But if it is over 5%, say 7%, as one of these correlations shows, then goodbye market, because you will see yields rising perhaps all the way to 2% in a rapid manner. And that will be a death sentence for the stock market. Folks, we have a very important day ahead of us tomorrow. Before I log off, I've been absent for a while and I've read your messages, and I appreciate all of you who asked about me and offered words of support and kindness. I appreciate you, and you motivate me to continue to do this regardless of how hard and time-consuming it is. Things will get a little better in the future in terms of my time, and I will be able to produce these videos more consistently. I've heard some suggestions that I should just do a charts analysis, etc., etc. When I created this channel, my goal was not to be the most popular channel on YouTube. Otherwise, I would have pumped the mania names and Tesla, etc., etc. My goal was to create a community of like-minded people and those who are interested in making trading and investing as a career for the long term. The audience I'm trying to target is not the people who are looking for tickers or just charts to confirm their pre-existing bias. These kind of traders come and go. I want to create highly engaged, highly committed type of audience that will be with me in the long term in this journey. Anyhow, that's all I got for you for now, but I will talk to you again soon.